We've been talking about making banking and all deposits safer amid back-to-back banking failures that have left the banking sector feel a little unsteady. My next guest is someone who knows very well the effects of bank failures. However, she doesn't exactly agree with me on how to fix it. Joining me now is Sheila Bair. She served as the chair of the Federal Deposit Insurance Corporation, the FDIC, during the 2008 financial crisis. She's the founding director of the Volcker Alliance, the founding chair of the Systemic Risk Council, and the author of multiple books, including Bull by the Horns, Fighting to Save Main Street from Wall Street and Wall Street from Itself, and a series of children's books about the banking system. So nobody knows more about this particular issue than you do, Sheila. It's great to see you again. Thank you for being with us.
Nice to see you. Thanks.
Why not insure all deposits just because that's what makes the banking system work?
Right. Well, a lot of reasons. It would create distortions on where money goes. So your phones are probably going to be lighting up for money market funds later, because if you complete, unlimited deposit insurance, then a lot of money that goes into money market funds now, I think, will flow into banks. I mean, that's a good thing or bad thing, but that would happen. You also could see money flowing out of very short-term treasuries into bank accounts too, particularly depending on what kind of interest rate a bank might pay on those unlimited deposits. It would be very expensive to do, I think, and it would benefit primarily wealthier people. As you mentioned earlier, Main Street households, 250,000 is significantly more coverage than they need. And that's really the core of the deposit base we want to protect. And finally, I do worry about moral hazard, because if we need the examination process is not perfect. The supervisory process is not perfect. The government is already guaranteeing over $10 trillion of insured deposits. Examiners still, they're great people, but they don't catch everything. And we really need market discipline behind them. The larger depositors, the more financially sophisticated people, taking a look at that bank and seeing if it's healthy. Now, if you want to provide greater protection for uninsured deposits, there is another way to do that actually increases market discipline, and that would be to raise banks' capital requirements and requirements to issue a certain kind of debt called bail-inable debt, which is converted to equity and is there to protect uninsured deposits if the bank fails. Those rules do apply for the largest banks, not to the mid-size. I think that's something that needs to apply to the mid-sized banks. But if they had larger cushions of both capital as well as unsecured debt, and people out there who understand bankruptcy know that those are the first to take losses before you get the deposits, that would do a lot to protect the uninsured.
So, yeah, I think there may be different ways to address this, and you're suggesting an interesting one. Part of what you said, though, is that the large banks do have closer examination. They have different structures in place, which is why we don't really worry that bank failures will extend their way all the way up to the top. Although back in 2008, we were a little bit shocked at the size of institutions that ended up failing, that you were able to either find buyers for or fix in an orderly fashion. But you got to the point. We can make banking is a very profitable business. Even if the banks don't do risky things with the money, they can just make money off of that simple chart that I showed people. You deposit your money, you get an interest rate, they take that money, they lend it out at a higher interest rate. You could take no risks and be very profitable as a bank.
Yeah, that's right. Well, it depends on the interest rate environment. But yeah, now, I mean, if you're making loans, you're getting a much higher yield, and deposit rates are going up, but I still think they almost always lag the rates a bank will get on loans. So that is why banks traditionally are profitable. Now, we do have a problem now with escalating interest rates. They've gone up so fast. And we have what's called a yield curve inversion now. So short term, the cost of borrowing short term is actually more expensive than long term. So short term rates are higher than long term rates, which is completely upside down. But if you're a financial institution that borrows short term and lends long, that can be a problem. And so I do think this is one of the reasons, many reasons why I've been saying the Fed should hit pause, let that yield curve, relieve the pressure on that yield curve, because that also can make what has traditionally been a very profitable banking model unprofitable. Again, if it costs you more to pay out your deposits than it does you're getting on your loans. And that's what we saw during the S&L crisis. I don't think that's going to happen now. but it is a risk that everybody needs to be aware of. And this is why Banking 101 requires you to manage your interest rate risk, which a couple of banks that just failed.
And that was a problem at Silicon Valley Bank. But there was a really active lobbying movement from these smaller and mid-sized banks to say this degree of regulation is very difficult for us. So how about you don't regulate us the same way? And can we at least reverse that and say, I know it's onerous, and I'm a pro-business guy. I don't want things to be unusually onerous, but I don't want banks failing either.
Yeah. Yeah. No, I don't either. And I think, yes. So I think there are certain rules that need to apply to these mid-sized banks as well. My only caveat with that is that I think interest rate risk, liquidity management is something all banks need to be focused on right now. And even the largest banks, some of them, if you look, they've got pretty large portfolios of these, securities that have lost market value but have not been marked down against their capital. So this is, and I agree with you that we've got much tighter regulation now than big banks. But I have to say one of the reasons they're stable is I think everybody assumes they'll be bailed out no matter what, which is not a luxury that the mid-sized and smaller banks have. So that's another problem we really need to deal with in our system, because you get in times like these, the money just goes to the big banks and they just keep getting bigger.
Sheila, good to talk to you as always. We'll get smarter for each one of these conversations. Sheila Bair is the former chairwoman of the FDIC.